Hello, my name is Jeff Grove. In this presentation, I will be discussing financial management and capital budgeting risk analysis, including a sensitivity analysis and evaluation of internal and external factors. The objective of financial management is to maximize overall shareholder wealth, not just short-term profits. This is done by focusing on increasing the company's value through proper allocation of resources, financial planning, and detailed risk management. Financial management includes these key functions. Capital budgeting is evaluating investment opportunities from a lens of value creation. Capital structure focuses on choosing the proper debt to equity mix for the given risk acceptance level. Working capital management ensures efficient use of current assets and liabilities to maintain liquidity. Financial planning and control involves developing a forecast, managing a budget, and establishing benchmarks to ensure goals are met or adjusting them as necessary. The sensitivity analysis is a risk evaluation method used in financial decision making. The sensitivity analysis is used to evaluate the amount of impact a change in one aspect of a project has on the overall end state. It allows analysts to evaluate how changes in variables such as sales, cost of capital, or inflation affect financial metrics such as net present value and internal rate of return. This analysis has value in understanding the volatility of assumptions and in making strategic investment choices. Qualitative analysis begins with identifying which variables have the greatest influence on the success of the project. Some examples of qualitative items to consider are sales volume, pricing strategy, and input cost. The manager will evaluate the credibility and volatility of inputs using industry knowledge, experience, and judgment. In some cases, a large change in a variable does not change the overall outcome significantly, while in other cases, a small change in a variable may have a significant impact on the project. These changes allow the manager to calculate the overall importance of a variable or assumption. Dalquist and Knight recommend analyzing competitor actions and market conditions to evaluate external uncertainties, which will help in understanding how qualitative factors change, like customer behavior or supplier reliability, and can provide valuable context when conducting the qualitative analysis. Quantitative analysis applies numeric inputs and produces numeric results. Examples of quantitative variables are sales volume, sales price, and interest rates. This part of the analysis involves creating a case-based model, then adjusting one variable at a time to determine the effect on the net present value or the internal rate of return. Dalquist and Knight suggest that this data-driven approach improves transparency and reveals which variables are most critical to the success of the project. There are a number of internal risk assessment methods. Irons explains scenario analysis is used to assess conditions such as changes in customer demand or internal cost. Break-even analysis is exactly as it sounds. It evaluates when the project will cover its cost. This is a critical metric used when evaluating the feasibility of a project. The Monte Carlo simulations allow financial managers to run large numbers of iterations with variable inputs to model the probability distributions of different outcomes. By running the internal rate of return variability testing, a manager can evaluate the attractiveness of the project using different internal conditions. External risk assessment takes in data that is less controllable by the company, such as macroeconomics, regulatory, and other industry factors. This assessment helps evaluate economic indicators such as inflation, interest rates, and exchange rates. Market research helps evaluate industry competition and customer behavior, while reviews of legal and political changes can help better prepare a company for what is ahead. Some other factors critical to success are supplier reliability and customer volume, which can impact long-term profitability. This can be assessed by evaluating the financial data of a competitor. Evaluating these external conditions allows the company to estimate how much control they have over the risks and whether the project is worth taking on. Integrating the analyzed risk into the capital budgeting process involves modifying the cash flows or the discount rate for specific risk related to the project. Melker and Norton recommend using a risk-adjusted weighted average cost of capital to ensure an accurate assessment of value. Sensitivity and scenario results are critical inputs for strategic planning and will be reviewed during evaluation for investment into a project. Excel-based financial models can incorporate risk assessments dynamically. This can be used to create real-time forecasting, incorporating assumptions as they change. This comprehensive integration into capital budgeting allows managers to be better informed and make decisions, resulting in more successful projects with higher rates of return while minimizing risks. In conclusion, the primary goal of financial management is to maximize shareholder wealth. Using the sensitivity analysis, managers can evaluate the qualitative and quantitative factors of a project and their impact on the net present value and internal rate of return. By incorporating the sensitivity analysis with other internal and external risk assessments, managers can make an educated decision whether to proceed or cancel a project. Finally, the project can be integrated into the capital budgeting process, and the best decision can be made regarding the success of the project. Thank you for listening.